we're going to be covering Chapter 22 in Accounting 102, Managerial Accounting. We're going to be talking all about performance measurements and responsibility accounting. So let's dive in. So when it comes to performance evaluations, a lot of companies are going to organize their different locations based on geographically, or it's going to be within one location. They're going to identify it by each product. They're going to put them into different categories. So responsibility accounting is unit managers are evaluated only on the things they can control. So they are going to have specific jobs and specific things that they're in charge of, and that is all that they are going to be measured on. So you may have worked a job before where you're like, I have had things that I'm getting in trouble for, and I had nothing to do with it. So if you have responsibility accounting, then you've got that broken out to where, no, I'm only going to be held accountable for things that I actually should be, things that I do have control over. So responsibility centers, there's going to be cost centers, and we're going to go through each of these throughout this chapter, profit centers, and investment centers. So the big question is, how do we measure the performance of each of these? So that's what we're going to be doing today. So performance evaluation. So we've got our cost center. Our cost center is evaluated on their success in controlling cost. That's their whole job. So maybe this is like at BMW, where it's a manager over one section of the assembly line. They can't control how many cars that they sell. All they can control are the cost for that one specific department. So that would be a cost center. Then there's profit centers. They're evaluated on their success in generating income. So there we're going to see more like the sales center. Okay, that's actually their job. That's something they can control. Maybe they have, they're closely knit with advertising, and they're going to be evaluated based on the sales they bring in, the profit that they make, the price they can sell it for, which makes sense because that's something they're in control of. Then we have investment centers. They are evaluated on the use of investment center assets to generate income. So we have assets, whether it's cash or whether it is going to be in a building or machines, and the investment center is going to be broken out into those individuals who are in charge of making asset decisions. So, okay, our choice is we have $500,000 that we've been setting aside. We need to choose, should this go to this department's project? Should this go to a new assembly line machine that will help be more efficient? Should this go to delivery vehicles? So then they're going to be based on how well they did at using that money, those assets, to generate more income. That's all they can control, and that's what they're in charge of. So controllable versus uncontrollable cost, we want to make sure that companies are split into ways that you are only responsible for things that you can control. It is not fair for you to be punished for something that someone else did, right? None of us like that. We all want to work in an environment that is fair and that we're treated correct, that we're treated right. And this is a big aspect of that. What is something you can control? That's all you should be responsible for. So let's look at a pretend company here. We're going to be doing a pet store company. So we have Canada, US, and Mexico locations. So we have a president over Canada, over the US, and over Mexico. We're going to focus on the president over the US. So we look at the president over the US and say, okay, you've got two regions. You have the Western region and the Eastern region, and you have vice presidents over those. Let's focus in on the Western region. So within that Western region, we're going to break it out into different responsibility centers, into different groups here, different categories. We have a manager over pet food, manager over pet toys, and manager over live pets. So we don't want the manager over the pet foods to be held accountable for how many puppies they sold. Has nothing to do with that manager. So we're going to break it down and we're going to look at the pet food. So let's look at how the company's doing overall. So this is for the month of August. So they have all of their controllable costs. This is the president of the U.S. operations that we're looking at. So we're only going to look at the U.S. numbers. It wouldn't be fair to hold that president accountable for Canada or for Mexico. So we see the vice president's salary. We see travel cost, office cost. We see the Western region and the Eastern region. So then we can break it down into more specific responsibility centers. And so we say, okay, we're going to go to the Western region as it is highlighted in red. And their budgeted amount was $494,100, but they spent $496,900. So we want to get to the bottom of why were they over budget by $2,800. So then we're going to go into the Western region to figure out why they were over budget. So then we go to the vice president of the Western region. Hey, what's going on? Why were you $2,800 over budget? So then they would present to us each of their line items. So we've got salaries for department managers, we've got depreciation, insurance, pet food, pet toys, live pets, and they would break out each one individually, but the one we're going to focus on right now is pet food. They say, hey, we gave you a budgeted amount to spend of $95,800, but you actually spent $96,100. $300 seems a little immaterial, but that's what we're focusing on today. So they go to the $300 and they're like, can you explain to us why you overspent by $300? So we're going to have to break that down even more. So we go to the manager of the pet food. So the manager of the pet food says, well, here's how it breaks down. Our direct materials were $61,600. So the actual amount that we spent was $62,500. So we were $900 over budget. We were actually under budget with direct labor and overhead. We did really well. Our employees were really efficient and we didn't use too much electricity. We didn't have a lot of overtime hours. But those direct materials, the cost went up. Inflation caused the cost of those to go up. Or maybe they had a big batch of their pet food get destroyed for some reason. There was a big storm and a leak in the roof. So for that reason, we lost some pet food. So then the manager would break down why is it that our direct materials is so far over budget. And then we see, okay, we thought it was just $300 over budget. But when you look at how the direct labor and overhead were under budget, it actually was a much bigger number. So sometimes breaking these things out kind of bring to light that, oh, okay, it actually was a bigger problem than we thought. We just had some things to offset it a bit. So then we're going to look into, okay, if it was a leak in the roof, let's get that fixed so that we don't have any more extra costs for direct material. If it's inflation, then maybe we need to change our budgeted amount and then we need to make sure we're charging the customers more. So we need to make sure that we are breaking these things out and identifying why are these over budget or maybe even under budget. Maybe we're way under budget. We're like, do you need that budget? Let's go into that and see. So breaking it out and saying the only person or the only thing that this manager is responsible for is the pet food department. So we're going to go talk to the live pets department separately to see what's going on in their department. But let's talk to who is actually in control of these costs. Hopefully you have a job like that they're only making you responsible for things that you can actually control. Okay, so then that was our cost center. Then we jump into the profit center measurement. So we have departmental income statements. So each department, whether it is the pet food and pet toys and live pets, or maybe it's different locations as a whole or regions, but we're going to have income statements for each of those. The biggest question usually is how do we allocate indirect expenses? So you've seen this throughout Accounting 102 already, managerial accounting. One of the biggest challenges are those overhead expenses. And if you have multiple departments and they're all sharing one big indirect expense, how do we allocate that? So we're going to look at those. And the same thing with service departmental expenses. So we're going to dig into those further. Okay, so direct expenses, those are really easy to track because we say, okay, if we are making, if we're making a pet toy and it's a tennis ball on a rope, it takes one tennis ball, one rope. Those are very direct. but what about the indirect expenses? And that's always the big question. So in order to allocate cost, and we're going to do an example of this, we take the total cost that needs to be allocated, everything that we need to spread across the different departments, and multiply it times a percentage of an allocation base that we're going to use. So this is very similar to what you've already seen when it comes to overhead and calculating that, but now we're going to try to spread it across these different departments. So let's look at how we might allocate these. So here's some indirect expenses, wages and salaries. We'll probably allocate those based on how many hours were worked in each department. If we go ahead and we're like, here's the big wages number, how do we allocate that? Well, how many hours were worked in the pet food department versus the pet toys versus the live animals? So they would allocate it that way. Utilities, that one can be a lot trickier because it's like, okay, we have this huge building and we are all using electricity, we're all using air condition. So how do you allocate that? Well, we're going to base it on the square footage of the space occupied. So if our pet toys has the smallest space, well, we're going to base it off of that. We're not going to charge them a third of the electricity if they're only using a fourth of the building. So we're going to see that broken out in an example in just a minute. Depreciation, if it's a machine, we're going to say, okay, how many hours have each of these departments used on the machine? And you're going to have to keep track of that and log it in order to be able to allocate that appropriately. Or maybe it's delivery vehicles or something, or maybe it's the building again. We want to do depreciation on the building. Well, again, that could be the square footage if we did it that way. If it's a machine or it's vehicles, we would do it on the hours that each department used that asset. Rent, again, the square footage of each space occupied by each department. And advertising could be the percentage of total sales. So, okay, we spent $10,000 on advertising this year. Well, 60% of our sales were in the pet food, so 60% of the advertising costs will go there if it's just something that's advertising the whole place. Now, if it was advertising that was only specifically advertising the pets that we sell, our cute little puppies, then we would probably allocate all of it to the pet department, right? So what if it is service department? So office expenses, payroll expenses, employee expenses, even maintenance expense. So for the first three, you see it's the number of employees in each department. It makes sense. All of those have to do with the people occupying the space. Maintenance expense, again, we're going to go to the square footage of the space occupied. If we're having, let's say, someone come and spray for bugs, okay, well, how much of the space do you occupy? That's how we're going to allocate it. If it's somebody that's coming in and just checking out a machine or something, then we would base it on how many hours in that case they're using the machine, kind of like depreciation. But if it's just maintenance on the whole building, maybe it's custodial services. Everybody's using the restroom. Well, maybe in that case, we're either going to base it on square footage or on the number of employees that would be using that. All right. So allocating indirect expenses, let's look at an example. So the electricity bill for this company was $750. They want to allocate it by square foot. So stick with me on this. It's not that hard, but you just have to make sure you're following along with me. So we've got pet food they have 1,400 square feet. We've got pet toys, they have 600 square feet. And then live pets have 2,000 square feet. So total, they have 4,000 square feet. We add all that together, their whole store is 4,000 square feet. So in order to figure out how to allocate the $750, we need to figure out what percentage each of them have of the store. So we take the 1,400 square feet for pet food department divided by the total 4,000 square feet, and we say, okay, they have 35% of the store. Pet toys, 600 square feet of 4,000, they have 15% of the store. And then an easy calculation, live pets takes up half of the store, 2,000 out of 4,000 square feet. So we take 50% and we are going to then multiply each of these percentages by the total electricity bill. So we have $750 times 35% gives us $262.50. That's how much we allocate to pet food. Our pet toys, we have 15% of the store, and we multiply that times $750. That's going to be $112.50 allocated to pet toys. Then our live pets, we have 2,000 square feet, half of the building. So we're going to take half of the cost, which is $375. Then we want to make sure we add all of that up because we don't want to be wrong and have done a calculation wrong. It should equal the same amount as the total bill to make sure we're allocating all of it. Now we're going to look at departmental income statements. So this really is just a regular income statement, but it's for each individual department. So we have our departmental sales for each department, whether it's pet food, pet toys, or live pets. Then we subtract out direct expenses, indirect expenses, and then service department expenses. And that brings us to our departmental income. And so this is the same thing as an income statement. It's just for each department, and this is just a horizontal look at it. But then giving us our departmental income is going to help us to lead into how the investment centers are doing. So let's look at how we would analyze the different performance measures for investment centers. So these are some really popular formulas that are not just used in class, but they are actually used for investors all the time. So we have return on investment, profit margin, residual income, and investment turnover. So we're going to look at these together throughout the next few slides. So we come to our investment center, return on investment, which you often hear called ROI as an abbreviation for it. So we're just going to look at these two departments. We've got pet food and pet toys. Our investment center income is $450,000 for pet food and $360,000 for pet toys. So whenever we look at the average invested assets, we are going to be able to figure out how much our return on investment is. So here's the formula for return on investment. We take the income divided by the invested assets. So this is exactly what you would do if you were trying to determine where to invest your money. Do you want to put it into the stock market that would typically return X amount? Do you want to put it into a rental property which would return X amount based on this formula? Do you want to put it into a savings account that would return a certain percentage? And you can figure all of those estimated return on investments out by using this simple formula. It's the estimation that can be challenging, right? At least this one we're looking back on to see what it was. So for our pet food, when we take our 450,000 divided by our 1,750,000, the return on the investment is 25.7%. That's huge. So they invested that much, and then in 1 year, they made 25.7% of their investment. That's a lot. It's kind of like, oh, on my savings account, I made 3%. Same idea here. So let's see how they did with pet toys. When we use this formula, we take the 370 divided by 1,970,000. They made 18.8%, which is also fantastic. But compared to the pet foods, doesn't look so hot, does it? But those are really good. So if you were trying to determine maybe a department to get rid of, then this would be one thing you would look at, which in return on investment is doing better. Now we are going to finish up with the last couple slides talking about investment centers. Let's look at how to calculate residual income. So we're just going to take the investment center income and subtract out the target investment center income. So every company should have some kind of target as to how much they would like to make, and this will help them determine whether or not they were successful at that. Anything over that is residual income. It's like extra income. So let's look at our store. We have our pet food versus pet toys. The investment center income, as we saw on the last slide, was $450 for food, $370 for toys. Their target investment income was $410 for food, which left them with $40,000 more than they were targeting. So that's fantastic. And then for pet toys, they were only aiming for $320, so they made an extra $50,000. So they did really, really well in this case. And that's how we calculate the residual income. During COVID, that was a big year for pets. People were at home, they were working from home, they had more time to spend with pets. So I have a friend that owns a company that they sell dogs, and that was just a record year for them. So maybe that's the situation here, or maybe it's just a regular year and they need to up their targets because they're doing so well. But just different things they want to consider with these numbers. Then we're going to look at our profit margin and investment turnover. So our return on investment is really our profit margin times our investment turnover, and that can also get us to our return on investment. So this looks at how much did we make versus how much how well are we doing with the investments themselves. That helps us get to the return on investment in a different way. So reach out if you have any questions, and I am happy to help. But hopefully this helps you to see how to better analyze a company based on what each department is actually responsible for.